afternoon, everybody. Welcome to our webinar, our first webinar of the year. You can see the topic, quick glance back and looking forward to the year ahead. So this is a quick analogy, introduce the webinar. I drive on the highway every day to the office in Midrand. And obviously when I'm driving, I'm looking at my rearview mirrors to see the cars around me and what they're doing. So it's a bit of what we call defensive driving. So I'm not so worried about my own driving, but I'm worried about other people's driving. So some of these cars are not roadworthy, number one, and number two, obviously you got some idiot drivers out there. So the idea here with this topic as such, rearview mirrors help you to remain aware of your surroundings while you focus on the road ahead. In a similar way, reviewing the past year or reviewing the past and learning from it can help you build a portfolio that preserves capital, number one, minimizes losses, number two, but also more importantly, generates a modest return in the future. So saying that, my name is Sean van den Berg. I'm an investment specialist here at PSG Wealth. And today I want to discuss ways to build a defensive share portfolio to help you protect your wealth, number one, and obviously amid this market uncertainty. And we've seen the last week or so since Trump has come in, how much volatility and upheaval we've had. Okay, so here's, like we do every month, here's my 3 topics. Review of the markets and obviously outlook for 2025. Let me put it up front that I'm not forecasting the market here. I do not know where the market's going to be in a year's time. I'm more of a technical analyst, so when I look at charts, I use that old cliche, the trend's your friend until it bends. So yeah, it's but I can't tell you where the market's going to be in a year's time. I can use things like a point and ticket charts, little noughts and crosses to help you anticipate might be higher or lower, but that's sort of not what I'm into. So the whole idea here is I'm more of a prudent investor. I'm looking for high growth opportunities with low risk. Saying it also, I look at high probabilities. Okay, so there's our agenda review, the 5 trends anticipated. And this is, when I first started doing this at the beginning of the month, there were some things, and now there's a whole slew of information out now regarding the investment landscape for 2025. But the main gist of this presentation today is how to form a defensive share portfolio. Okay, that's where I want to focus on mainly today. So let's move on and let's talk about the review of the markets as such. So last year, 2024, demonstrated a remarkable resurgence in global financial markets that was characterized by the resilience and renewed optimism. So you might feel the same way. And this was obviously following challenges of the previous years, I can say for the last 4 or 5 years since COVID. Okay, so equity markets outperformed across the board. You'll see on our next slide of the table how the markets performed, but they were basically buoyed by strong economic fundamentals, technological advancements, and then also region-specific policy measures. Okay, so here's the table of, this is taken from our daily newsletter. You can look at the bottom there, you can see my source. There's tables in there. Basically, I've just done a quick summary here. So right up top, you can see the JC All Share, our main market. And right across on the far right hand side here, you can see how this is obviously a rolling year. But basically, we're up to 16.5% compared to a year ago. The S&P 500, which is the broader market in the US, up 26%. Okay, the best performing market was Hang Seng, was the Hong Kong stock market, up to 37%. And you can see there also the German market performed. That was the Frankfurt market. Okay, right at the bottom you can see some of the commodities. Gold was up 36%. A lot to do with inflation, a lot to do with a safe haven status, etc. Also interesting to see that the oil price is slightly lower compared to a year ago. Talk about inflation. Okay, and right at the bottom there you can also see the rand relative to the dollar. Basically we're flat, slightly weaker, up 0.89%. But yeah, we'll see what happens this year. So let's talk about that. So looking back, US markets, the US economy reaffirmed itself as its position as the global growth engine. A lot to do with strong consumer spending, a healthy labor market, and obviously resilient corporate earnings. So that translated into real GDP growth of 2.6%. That's quarter-on-quarter growth, and that was analyzed. So the US equity markets, as I say, outperformed globally. The S&P 500 index achieved a total return of 25%, and that's in US dollar terms. The Nasdaq Composite, that also went up 29.6%. So the key driver was what we call the Magnificent Seven, or the mega cap technology companies. Collectively, obviously these are the what do we call the FANGs? It's Facebook and Apple and Netflix, etc. But saying that, these collectively gained 67.3% last year. And another way of looking at it, they accounted for 34.6% of the S&P 500's market capitalization. Or another way of looking at it, that 34.6% translated to 16 trillion of the 46 trillion total. Wow. Okay. So interesting to see that it's got a lot to do with AI technologies, and just saying that the big thing this week is the stock market, stocks plunged on the back of a Chinese company called DeepSeek, which rattled the markets. So it's quite interesting. What is AI? What is DeepSeek? Basically, the Chinese AI model. It's an app that you download on Apple iStore, for example, and obviously a lot of investors have grabbed this, and obviously it has a big impact on the market. So I saw that President Trump said it was a wake-up call to US companies, obviously to focus on competing to win. In other words, innovate like crazy. It also reminded me of the good old days we used to have the space race with Russia. We can call this a Sputnik moment. Okay, so what makes DeepSeek so special is that the company claims to have built the application at a fraction of the cost, okay, of the industry-leading models like OpenAI, because it uses fewer advanced chips. And obviously this took a big knock on the market. If you look at companies like NVIDIA, I saw on Monday they were down nearly 17%. Yesterday they bounced back about 10%. But yeah, it was quite interesting to see this rattle of the markets. Financial stocks, they also contributed significantly, a lot to do with potential deregulations from the Trump administration. But also what I've done now is right at the bottom, you can see I've added some ETFs, exchange traded funds. They trade like shares, you can have them in your portfolio. This is one way to diversify your portfolio, but also a way for you to have exposure to these markets. Okay, so there's an example there. Going over to the UK market, they delivered a respectable 9.5% return. That's in pound terms. A lot to do with a cyclical recovery, and also obviously the general elections. I was reading somewhere there was over 70 countries that had elections last year, and South Africa being one of them. Saying that, obviously we saw in the UK a challenging autumn budget, a lot to do with significant tax hikes. And obviously this has dampened business sentiment, number one, and number two, obviously consumer confidence. But the S&P, the FTSE 100 still demonstrated resilience. This was supported by strength in energy, healthcare, and financial sectors. Okay, you'll see a trend, a theme coming through in this presentation today. The Bank of England, the Reserve Bank, remained focused on inflation management, and they focused on that mandate, but also obviously still dealing also with the impacts of Brexit. Okay, so there's the ETF there. If you want exposure to the UK market, there's a nice one here from Signia. Going over to Europe, the broader Europe, they're having a bit of a challenge there. The economy has been hindered by high energy costs. Obviously, a lot to do with what's happening with Russia and the Ukraine there, and the oil from Russia. And also a lot of regulatory challenges. And we've also seen a lot of slowing in manufacturing activity from key economies like Germany and France. Okay, so the European equity markets posted a 8.1% return in euro terms, which is still way below the US benchmarks. European bonds, however, they outperform core markets, and that's on the back of expectations of future interest rate cuts by the European Central Bank. Yeah, we'll talk about interest rates just now a bit more. Energy sector, as I said, continue to struggle. This whole transition to renewables obviously encounters some logistical and financial obstacles. If you want exposure to the European market, there's a top 50 stocks you can have exposure to through that ETF. And then looking at Asia, a bit of a mixed performance, but obviously Japan was the outperformer there, nearly at 20.5%. A lot to do with government reforms, rising real wages, but also a weaker yen helped with export, make it more competitive as such. China, as I said, saw a late year rally in equities. They were up 19.8%. A lot to do with government stimulus measures, and there are signs of recovery. But there's also ongoing concerns in the property market, but also you also see the consumers are hesitant and hence weaker consumer sentiment. But as I said just now, we saw with DeepSeek, we might get some surprises out of China still this year. South Korea and Taiwan, they deliver strong returns. That's got a lot to do with the whole global semiconductor supply chain and the exposure there. But we'll see what happens with Trump. He wants to bring businesses back to US, especially the semiconductor businesses. Again, if you want to have exposure to Japan or Asia, there's the two ETFs that you can use. And then looking at South Africa, I believe the pivotal event last year was the elections, the May elections, and which formed obviously the government of national unity. So I think it was better than expected. But the South African markets delivered a mixed performance. Our equities, we rose about 21%. That's the SWIX. A lot to do with improved economic sentiment, a lot to do with this government of national unity. The bond market, they posted a robust 17% return. This is obviously on the back of declining borrowing costs, domestic borrowing costs, despite also global interest rates rising. Okay, anticipation of inflation being still high as such. Saying that, our rand also showed resilience, was the fourth best performing currency against the dollar last year. That was quite interesting. And obviously, the last week or so, we've seen how it has weakened with this whole land expropriation bill being put out there. Again, just fear driving the markets, but it will pull back again. So let's look at the outlook for 2025. The US markets are still expected to be in the focus, in the light. Okay, we anticipate healthy growth there, at least 2.5% growth per annum there. Although they are saying the inflationary pressures are easing. We don't know what's going to happen with tariffs. There's a lot of unknowns there. But the positive is that the labor market remains stable. Okay, so a lot of analysts anticipating the S&P 500 to grow between 10 and 25% this year. So yeah, interesting. AI will still be a defining theme, or we'll see how things rock the technology sector there. But broadly, I would anticipate that the economy, in a broader sense, will be involved. Bottom line, creating a healthier investment landscape. Okay, so yeah, globally we anticipate more diverse opportunities and challenges. Hence, the reason why I'm putting all those ETFs in, so you can have exposure offshore, things like that. Okay, but a more dynamic and diversified market environment. That's what we have on offer here. And then let's go quickly over to the 5 trends anticipated. And when I first thought, as I said, when I first started this beginning of January, this theme, There wasn't a lot of information out there, and suddenly there's a lot more. And I saw even our Adrian Pusk, the PSG Wealth Chief Investment Officer, released a note today about the outlook for 2025. And obviously, I haven't had a chance to read through it yet. But saying that, how do you prepare your investments for the first 6 months of 2020 of this year? The first 6 months, that's what we're focusing on. So is it business as usual as you prepare your portfolio for 2025? The reason why I say 6 months in the stock market is a small blimp. Nothing happened. It's the long, in the big picture, it doesn't mean anything. But the first half of 2025 promises to be different because it's the beginning of President Trump's second term. And obviously promises many changes. And we've seen this already in 1 week, the changes. We've seen looser, we've seen obviously the mass deportations, number one. We could anticipate looser regulations. We could also anticipate tariffs. We see this threat of tariffs all the time. Nothing's happened yet. We see what happens from the 1st of February. But there's also obviously the Federal Reserve, whose announcement last month, December, rocked the markets, and we can anticipate more announcements this year to create more uncertainty. So January through June of any year is when economic trends, policy changes, and corporate strategies begin to reveal themselves, and also when many investors adopt a clean slate with renewed discipline. So this is what I'm offering you now, to have this view of a clean slate as you prepare yourself for this year. So the first 6 months will be good, indication of what policies are likely to be put in place versus those that are turn out to be just campaign promises and political posturing. So we've seen already that we've got the NHI here in South Africa. We've already seen the Bella Bill, the education bill, and as I said last week, we had this expropriation, the land expropriation bill. So we'll see what happens. I believe that there'll be a lot of legal challenges, there'll be a lot of court battles, and it's going to take a while. It'll take time. Okay. So the year 2025 does bring excitement, it does bring uncertainty, and like every year, it is time for a reset. So the first 6 months provide both a taste of what's to come, and it's time to try your best to make your portfolio market neutral. And that's what I want to talk about. Make your portfolio market neutral. What I mean by that, it performs well whether the market goes up or down. Okay, that's despite what happens with Trump administration, despite what happens with interest rates, and despite what happens with global world events. Okay, so I hope that gives you some insights. So let's go off into the first one. So the first one I want to look at is obviously we spoke about, the last few years we've had this challenge here in South Africa about load shedding, and Eskom has come to the party, and we've just got over 300 days. But in the States, the electrification of everything world, we believe that many regulated utilities will once again become growth engines, although they might be modest, to be consistent. But the thing is, they're not being priced into certain companies' valuations. So we believe there's opportunity there. So especially in the electricity and transmission and distribution sectors. Remember, this is focused on the US markets. So right at the bottom here, I've got those two ETFs, Satrix Global Infrastructure ETF and the Smart City. And I think that's going to become more and more of a focus going forward. Okay, so again, it offers that what we call defensive growth opportunities. And then going over to China, we have already spoken on China. What I find interesting about China is that the Chinese corporates, the companies are sitting with, on average, about 27% of their market capitalization in cash reserves. Okay, so there's a focus on technology, specific sectors, obviously technology and clean energy. But there's opportunity there where the government is supporting shareholder returns. Again, there's two ETFs at the bottom there that you can take advantage of, have exposure to China. Okay, and then going over to inflation, This will be a challenge this year. We were anticipating interest rates to come down. We've seen that the interest rates might be kept higher for longer. We've seen that the Fed will be meeting today, and the expectation is they'll keep interest rates unchanged. Here in South Africa, we're leaning more to an interest rate hike, which is quite scary. But you can have exposure to inflation-linked bonds. It's a nice hedge against inflation. They offer a real hedge, real yields of 5% plus. If you compare that to US yields of about 2%, they're the highest in 2 years. So here in South Africa, you can have exposure to those two government inflation-linked bonds, ETFs. If you want to have that into your portfolio, it's just another way of diversifying your portfolio. And then avoid the landmines. The reason why I put this in is just that, especially with uncertainty, you want to avoid companies that have a weak business model. What I mean by that, companies that are capital intensive with high fixed costs, they have weak fundamentals, they have overstated earnings. So you want to look for companies that are resilient. You're looking for companies that are cash generative. I prefer companies that do not rely on economic growth to deliver. I prefer companies that are high free cash flow and have a strong market positioning. So yeah, I've added some 4 different defensive sectors, you can call them that: consumer staples, healthcare, telecommunications, and then food retailers. So you know, the food retailers, I believe I like Spar. A lot of people like ShopRite. In the food sector, I like AVI. I think the results also came out today or yesterday. And then in the healthcare sector, yes, I've got healthcare. We're talking about medicines and things like that, health products, but I like the Netcares. One thing I forgot there also is Active Ingram, another pharmaceutical company you can look at. And then obviously on the telecommunications side, we have spoken about MTN before in our weekly Q&A sessions on a Thursday. I prefer Vodacom. But MTN is growing, well, the more expansionary, they're more diverse, put it that way. Okay, so we spoke just now about Netcare. I believe that hospitals will deliver you healthy returns this year, despite the NHI concerns. You know, NHI is complex. It is a costly concept. We anticipate significant delays. To take at least 6 years to get these things slowly sorted out. But you know, I anticipate again further legal and logistical challenges going forward. But private hospitals should remain a compelling investment. When I say private hospitals, yes, we've got Netcare and we've got Life Healthcare. Netcare, I believe, is they invested significantly in IT systems and infrastructure. The reason why they're doing that is just to drive cost efficiencies, but also to support robust earnings growth. Okay, so that gives you some insight. So why a defensive share portfolio? Why I say that? Just now, remember I said to you market neutral. That's his idea. But let's talk about what is a defensive stock? What is a defensive sector? So defensive shares are companies that whose underlying business is expected to generate reliable revenue and profits regardless of the wider economic environment. So this is because they hold a dominant market position. Think of those companies I mentioned just now. They hold a dominant market position. They hold a reputation for value for money, and they even simply provide the bare necessities. Okay, so they're usually blue chip companies. They benefit from the electricity. Yeah, tongue-tied here, of demand, which makes them basically what we call safe havens. Okay, so here we go. I'm going to highlight some more what we mean by defensive stock. They really deliver significant capital growth. If you look at a company like Evertech, the share price here has been moving sideways for a long time. Okay, so they don't fly straight up out of them the whole time like the Naspers of the world. Okay, so they tend to underperform during bull markets, but in bear markets they are more attractive because of the consistent earnings. And this is where you can have a bit of a I call it a contrarian investment approach. So investing in these are defensive stocks, especially when it comes to its timing. It's not as simple. Okay. So if you reposition your portfolio too early, you might miss out on additional growth before a downturn becomes severe, number one. But also, when the economy does recover, defensive shares can become undervalued as investors sell in favor of growth. Okay. So it's a bit, your whole portfolio doesn't have to be defensive. Just have some element of it being defensive. So you buy these shares, these type of shares in a bull market, and you sell them in a bear market. And as I say, it's a popular contrarian investment strategy. Okay. So I hope it helps. So let's look at two sectors I haven't really touched on. Number one is the private education providers. And I know that 2025 is a make or break year for South African education system. We saw that the matric results came out, I think, about a week or so ago. That was a class of 2024, and the official pass rate was 87.3%. Nothing really to celebrate. The way I look at it is that if you look beyond the surface, the reality is far more troubling, and obviously also reveals a system that is in crisis. So there are three listed private education companies on the JSE: Evertech, Curro, and Stadio. I lean towards Evertech, personal preference. My children just go to Trinity College, Trinity High School. So I guess I got shares in the business indirectly for school fees. So Evertech is my choice there. Curro is also a great little company to look at, and the Stadio was unbundled out of Curro. But you can see also I've added the PE ratio. So Evertech is not the cheapest. Curro is more cheaper from a PE rating. But you can see there that Stadio is highly rated at 25.22 PE ratio. You can see the dividend yields there. Evertech, as I say, it's got a bit of a higher dividend yield. As I say, I like Evertech, something to look at, having some element of defensiveness in your portfolio. So you might say, what about the billable? As I said just now, same with the NHI, to take a while. Okay, there'll be a sort of low legal challenges in there. And then let's look at food retailers. Yeah, you can look at ShopRite, Spar, and Pick n Pay. Some people say, what about Woolies? Woolies have got also the clothing and homeware, so that's why I included it. I wanted to concentrate more on food retailers. So the top performer there is obviously ShopRite, very popular, done very well compared to its peers in share price performance. We know all the brands: Checkers, Hyper, and obviously the liquor shop. The online sales platform, we've seen the bikes, the 6060 bikes, that has driven a lot of growth in sales. You can see again the PE ratio there, 24.6. It is highly rated, so the demand has pushed the share price up. You can see the dividend yield there, also 22.43%. I personally like Spar more, slightly lower at 18.88 price earnings multiple. And then Pick n Pay, lastly, there's something you might be a contrarian. You want to say, okay, let's go look at Pick n Pay because they might bounce back, etc. But to me, they're still struggling financially. They're still going through a lot of going through that turnaround strategy, what they call a back to basics turnaround strategy. They've got a negative PE ratio, which means loss making. We saw that they lost until February last year. They have 3.2 billion loss. Okay, so it's going to take a while for them to turn around there. But with them unbundling a Boxer and things like that, we'll see what happens. Okay, so yeah, those are my picks. Those are the ones I like. Okay, let's do a quick summary. So the South African economy, I believe, is going through a challenging landscape. We've seen this cracks appearing suddenly in the new government, this government of national unity. We see what happens with this land expropriation bill and the Bella bill and the NHI. We also seen the implementation of a two-pot system on the retirement. Personally, I suggest you stay away from that. The tax implication is hectic. And then obviously the big thing is going to be the big driver this year is inflation, rising inflation, and interest rates. Interest rates might be kept higher for longer. So having a defensive investment strategy, what does it entail? Again, we've spoken about this in previous webinars, rebalancing your portfolio to bring it back to asset allocation parameters, buying good quality companies and diversifying your portfolio. Another way you structure your portfolio also. And then holding cash available for opportunities when the market does turn down. Okay, so we spoke about some defensive stocks, expected to generate reliable revenue and profits. What do they look like? They hold a dominant market position, they hold a reputation for value for money, and they basically provide the bare necessities. Okay, so we have touched on those a lot. So in conclusion, before we handle any questions, these are our investment vehicles we always talk about. As I mentioned, Adrian Posk, our CEO, announced his outlook for 2025 today. You might want to go touch on that and see how it goes. So hopefully this webinar will be available to be sent out here by Friday morning, the latest. But I also send the PDF of the presentation. Any questions you guys have, you're welcome to contact me on 0860 000 368 or by email, wealth@psg.co.za. So let's see what kind of questions you guys have. Okay, questions. Here's a question from Johan. Those ETFs that I mentioned, how do I get hold of them? Okay, Johan. Yeah, so yeah, obviously ETFs do present opportunity for you to diversify your portfolio, especially geographically. Exposure to offshore markets or to sectors that are not available in South Africa, nice way to spread your risk. And then obviously, yeah, to answer your question, the easiest way is through your share portfolio, your existing equity account. They trade like shares. I'll put the share codes behind each one of them so they trade like shares. If you don't have an equity account, you can either open up an equity account or you can go to a website like ETF SA and you can actually have exposure to them on a monthly basis, like 300 Rand, I think it is. Okay, so hopefully that answers your question, Jan. Here's a question from Tembi. I mentioned the education providers. What about the billable affecting the private education companies? Yeah. Tembi, as I said, I did touch on it. The way I see it is that the Basic Education Laws Amendment Bill, or what they call the Bella Bill, is will affect primarily the public schools in South Africa. Not the private education or private schools as such. However, the Bella Bill does affect homeschooling. I know quite a few people in my church do homeschooling, so they are worried about that. But also it may have implications for private schools in the sense that they might have to revise their policies and codes to ensure they're more constitutionally, call it constitutionally compliant. But also they might have to look at things like the admissions and the curriculum and things like that. So yeah, and that's where the contention lies, a lot to do with control taken away from the school boards and given to the Minister of Education. So yeah, it does present uncertainty, but with uncertainty, I believe there's opportunity. Okay. Let me see what other questions you have. Here's my disclaimer. Everything I said today is meant for education purposes. I'm not telling you to rush out to go buy these stocks, but do your homework. And obviously, as I say, the whole idea is to build a defensive portfolio. So from my side, guys, thanks for being on this webinar. Until next month, February. Bye for now. All the best.